All right, so let's go ahead with the class. Once again, good evening, everyone, for for joining. And depending on where you are joining from, it can be morning, it can be afternoon, it can be evening, because anyone can join this class as far as you have internet connection anywhere in the world. Okay, so this evening we are going to be 1 minute, please. So I sent a short intro basically to what we plan doing today, and that was the voice of the FS chief. His name is called Jared Martinez, and is the founder of Market Traders Institute in the United States. Uh, uh, he's a he's a renowned trader with well more than 30 or going to 40 something years of trading experience. And his organization probably have trained, more trader than any organization that I know in the world today. So his teachings in Forex, they are they are top notch, and he is one of those that pioneer the concept of the Fibonacci that you have on most of the trading platforms that you have today. So his contents are wonderful and they are distinct. And I can tell you for free that is my contact with Market Trader Institute that actually changes my complete orientation when it comes to forex trading. And honestly, over the years, I've been able to, to put to work several of his, principles, his concepts, his ideas. And as far as the forex market goes, I will tell you that they work. So a lot of the things that I do, they are born out of maybe the slide, the content, the presentation, from materials, that I was able to, pick from Market Traders Institute. So is one place or one organization you may also want to check out. As time goes on, I'll show you, some of their websites and their products, and the way they operate. It's a very big institution. If anybody tells you that forex market or forex trading is not lucrative, or people are not making money in it, that person need to go and check out Market Traders Institute. All right. So uh, yesterday was my birthday, and thanks to every one of you who, in one way or the other, send me some words of encouragement, prayers, talking. Yesterday was also a hectic day for me at work, but then somehow in between, some people were able to squeeze in a form of celebration for me, and I really appreciate that. And then, born out of that, I'm also willing to, show you, some key principles that you can leverage on in terms of trading in the forex market. So I mean, the appreciation goes on, and it's a continuous thing. We are not going to celebrate the birthday every day, but then, I mean, the memory stays with us. Okay, so that's just by the side. Uh, to comment on what we are doing, I sent a message yesterday or early this morning on how far we have fared. Let me see if I can just pull up my my folder. Okay, so I'm sure if you can see my screen, I personal stream this. All right, so we've done this, 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 and we've done this. So from my models, we've done 7 of these models, okay? And today we are going to be doing this, okay? Add the larger time frame, control the smaller time frame. And before we do this, we are going to do something that is not here. I'm going to include it maybe if the time permits, because it's not so long, I probably will do it today. Okay, and that's called reversals. Okay. It's not in this list. I'll add it to this list. Then before we come to this usually is my last topic. Okay, the 7 irrefutable keys to execute a successful trade. This is usually my last topic because it is like a recap of everything that we have done from beginning. Okay, so as you can see, we've gone almost close to the finishing of this class. And today, what we are going to do today is a game changer. Okay, a game changer. But maybe after now, by the time you finish taking this class, you just know okay, this is when I'm supposed to enter the market. I'm talking about seeing how you are able to see that different time frames are lined up together and they are heading to the same direction. And based on that, you want to trade the market. Okay, so that's basically what this course is all about. So we have completed, several stuff. And just like a knowledge check, we've talked about trend line, we've talked about, both in the uptrend and the downtrend. We've talked about how the ABCDs are formed. But I want you to understand something that if you want to take the Forex market as a game, that's fine. Okay. But I want you to see it in a particular perspective. And that perspective is, you know, uh looking at forex trading from the perspective of A, B, C, and D. So if you must call forex a game, have it in your mind that A, B, C, D is one game. Okay. So in order for you to win this game, if you take a table tennis game, that's talking about the ping pong now. You take the ping pong game, you want to have your best 3 games, right? Out of 5. You want to have your best 3 games. Now, if you play that game, out of the 5 games you are going to play, if you win 3 of them, you are a winner. It's just like taking penalty in a football match, right? So if you win 3 of those games, you are a winner. But if you are unable to win 3, then you probably will be at the struggling mode. Okay, why am I saying that? So if you say, because I hear people say that forex is a game, forex is a game. Now, or forex is gambling. I hear it a lot. But the truth is, yes, some people may call it gambling, and it's only gambling to those that don't know what they are doing in the market. For those that know what they are doing, it is not gambling. If I know, if I know, okay, that for sure this market moves in price swing, that is, it starts from A, it goes to B, comes to C, and then it moves to D. And when it has finished completing this action, is going to repeat this action again. If I know, then it's no longer a gambling for me. Yes, it could be a game. And like I said, this movement from A, B, C to D is one game. So what you want to do as a trader, this is what you want to do. You want to make sure that if you do this thing 5 times, if you do this thing 5 times, if you play this game 5 times, you want to win minimum 3. Minimum. You shouldn't win anything less than 3. If you win anything less than 3, you are in trouble. But if you win 3, if from a game of 5, you are the winner. Okay, so you want to make sure that you don't win anything less than 3. And how are you going to do that? How are you going to achieve that? Now, you want to ensure that first, when the market creates the A and creates the B, your work is to wait. What you need to do is to wait for the market to create C. And we have said that there are several criteria that helps you to know your D. And one of those criteria is when the market forms a candlestick in the AB boundary. So the market goes A, B, and is coming to C. We don't know where C is, but as the market is coming to C, it's going to hit this level, this level, this level, this level, this level. And according to Fibonacci, there's a high chance of the market bouncing from this level, or 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 bouncing from this level. So what you as a trader you are looking for, when the market gets to this level, did the market create a candlestick? No, that means the market will still go below. Okay, so the market continues to the next level. You ask yourself, is there a candlestick formation? No. The market is going to continue. The market will never reverse without a candlestick formation. It is not possible. In fact, candlestick formation is the U-turn in the market. The market cannot create a U-turn without candlestick formation. Okay, so your work is to look for where am I going to see that candlestick formation. That's condition number 1. Then condition number 2 is that the C will most likely, in fact, 90% of the time, the C will come from the deepest previous resistance becoming a support, or previous support becoming a resistance. So you finding a candlestick on a previous support that become a resistance in this AB boundary is a good indication that you have seen your C. And that's not all. That's not all. You're actually going to do one more step, in fact, 2 more steps. The next step is that you're going to put a counter trend line on your chart. When the market breaks the counter trend line, there's a tendency that the market is going to buy. But one thing that will let you know that of a truth this market is going to buy is when your stochastic is now coming out of this zone. Is coming from the oversold zone. If it's going to sell, it's going to be coming from the overbought zone. So you see your stochastic moving from below across this 20 line is an indication that the market has, market has exhausted its oversold ability and is going to now start buying. So you see the candles, you see the stochastic leaving the sell zone. Okay, you see the stochastic leaving the sell zone, and then you put a counter trend line. The market breaks that counter trend line, and next you see a candlestick formation coming from that zone, and lastly, that zone should be the deepest in this AB boundary where you have previous support becoming resistance, or previous resistance becoming support. Talk to me. Is these conditions, are they clear to you guys? Unmute and speak.
I want to ask a question. When you mean candlestick formation, can you be very clear with it, sir? Because that is after retracement, sir.
Okay, 1 minute, 1 minute, 1 minute. Let me just go. Let's show you. I share this document to everybody, okay, on the group. So let me just take you to, these are candlesticks, right? These are different type of candlesticks. And now I want to just take you to the 5 most occurring bullish and the 5 most occurring bearish candlesticks. So you have them here. I think okay. Let me give you the summary. I know I posted it not too long ago. Right here. Right here. All right. So, have you seen this document before? These
No,
are
sir. No.
okay. Okay, if you've not,
Yes, I've seen it.
okay, perfect. I shared it on the group. I'm sure a lot of you must have seen it. According to MTI, these are the 5 most occurring bullish candlestick formation. The first one is the shooting star. The second one is the morning star. The third one is the bullish engulfing candlestick. The fourth one is the PSC line, and the fifth one is the tweezer bottom. Tweezer, everything you see here will make the market to buy, and they are all U-turn. That is, you see the way the arrow is looking. It's giving you a U shape, telling you the market is turning. The market is doing a U-turn from that point. So every time you will see your C, you must see one of these candlestick formation. This is for the bullish, and the next one is for the bearish. These are for the bearish. So for the bearish, you have the dark cloud, you have the bearish shooting star, you have the evening star, you have the bearish engulfing candle, you have the dark cloud that is the opposite of the piercing line for the bullish, and then you have the tweezer top. Just know these 5 candlesticks. There are so many candlesticks. We have so many candlesticks. Okay. If I bring you here, 2017 candlestick formation. All right. So if I bring you here, all these are candlestick formation, right? There are so many. The Abaddon baby is a candlestick formation. The advanced block is a candlestick formation. The Bethwood, breakaway, doji star, dragonfly, engulfing pattern, anti-man, all this. Yes, 1 minute, I'm coming, Timothy. I'm seeing you. All these are candlestick formation, right? But now I want you to know all these candlestick formation. Okay, if you just go to Google, just type candlestick pattern on Google, it will bring all of them for you. Okay, but beyond knowing all this candlestick formation, I want you to have at the back of your mind that in the market, these 5 are the most occurring. You see these 5 most as compared to any other candlestick formation in the market. So if you have this at the back of your mind, when you are looking at the market, when you are looking at this ABCD formation, okay, and you are waiting for the market to come back to C, you will be waiting to see one of those candlestick formation. And I just said 2 things now. I said the place where you will see it is, one, that place will be previous support that turns to resistance, or previous resistance that turns to support. But by research, the best is when you find it in the deepest the deepest. So this is your A, this is your B. So this line, these two black lines are your A-B boundary. Okay, this is the boundary of your A and B. So the deepest previous support becoming future resistance in the AB boundary is the likely place where your reversal is going to come from. So when the market start moving into that area, you start looking at for candlestick formation. When candlestick formation comes out, that is step number one. Step number two is you put a counter trend line on the chart, and you see that that candlestick formation will probably be the candlestick that will break that counter trend line. Now, if the candlestick breaks that counter trend line, and that candlestick formation itself, if it breaks the counter trend line and that candle goes above the counter trend line, maybe 70% of the candlestick on that above the counter trend line, just take your trade. But sometimes the candlestick formation may not be the one that will break the counter trend line. So you will need to wait for another candle to break the counter trend line after the candlestick formation has formed. Then lastly, while all these are happening, you throw your stochastic on your chart. You want to see that your stochastic is coming from bottom below the 20 and is exiting the 20, exiting out of the 20 line. So the 20 line, anything below the 20 line means that the market is oversold. Anything above the 20 line means that the market is market is buying. And anything above the 80 line means that the market is overbought. And when it turns back into below the 80 line, it means that the market is selling. Okay. So these are conditions that you need to do. Timothy, let's go with your question, Timothy. I hope that's answer your question.
Yeah, thank you very much, sir. Yes, it does. Thanks.
So mine is not actually a question. I think I missed when you shared the slide for candlestick on the group charts. I know of only one document that you've shared, like a textbook, which I've been going through, but I don't think I have this one you displayed before now when this person asked this question.
Okay,
I
no
will
problem.
appreciate if you can help me drop it again.
I will share it again. I will share it again after now. Humphrey, let's go.
Okay, good evening, everybody in the house.
Good evening.
Yeah, my own concern is looking at this illustration of this ABC illustration of the market movement. I don't know if this is also applicable when the market is consolidating and you want to trade, because typically this illustration has to be when the market is trending, you know.
Okay.
So my question is, in the case of when the market is, because I know that most of the time the market is trending, about 70% of the market movement is trending, and 30% of 70% is consolidation, and then 30% is trending. So
Yes.
I don't know if during when the market is consolidating and you want to trade, if you also have to look out for these candlestick patterns, does it still give these patterns when it is consolidating and maybe reversing within that consolidation zone?
Okay, very good.
Or typically we just have to forget all about when the market is consolidating and trade only, when it's trending as beginners.
Oh, no, don't worry. I will explain to you.
Okay.
Very
Okay, sir.
good question. I love that question. Now, that question is going to take me to tell you something about currency and stock. Now, I want you to know this from today, in case you don't know. Do you know a stock can be poorly managed and it will go out of business? A company can close down. Let's say Heritage just closed down in Nigeria, Heritage Bank, right? The government just shut Heritage Bank down. That means to say people that invested in Heritage stock, they are presently suffering, right? A stock can go out of business. But guys, currency can never go out of business. Currency. Nigeria cannot stop existing. The United States cannot stop existing. So when you see USD, NGN, these two currency, They will continue until rapture comes. I don't know if you get my point. So a large portion of what we do in the forex market is really consolidations. You know why I say so? Nigeria and the United States, they have an agreement that this your price that is going up cannot exceed so and so value. When it gets there, the country will inject money into the system to move it to the other direction. If it gets to a particular point below, the country again will come and inject money to move it to the opposite direction. So what we are actually trading is actually complete consolidation. But you are not seeing it because you are trading 1 hour. Go to the monthly chart, you will see it there. If you go to the monthly chart, the thing that action of both countries is visible on the monthly chart, but it's not visible on the hourly chart because the hourly chart is too small. So what seems like consolidation on the larger time frame is actually a trend in the smaller time frame. So what you want to do, offering, is this. You want to go to a higher time frame, look for a large consolidation. So we have two types of consolidation in the market. We have what we call small consolidation, and we have what we call large consolidation. So consolidation are actually predictable. It's easy to predict. Okay, let me jump to another slide. You know, sometimes because of the question, I need to move to a slide that I did not plan to take. Okay, so let's go to this slide I told you is the last slide I normally take. The 7 keys. Okay, I'm not going to take this slide. I'm just going to take you to consolidation. Boom. Now this is a consolidation. Look at this. Look at this area. This from year to year, the market is constant. This is a high, this is a low. This high came back to the previous high. This low came back to the previous low. This high came back to the previous high. This low came back to the previous low. What are you looking for? You are looking for candlestick formation, number one. You are looking that the market breaks that counter trend line, and then you are looking for the stochastic leaving either the buy or the sell zone. This is all you need. You already know that if you enter this market from here, it will come to here. You will enter, you put take profit here. You enter from here to sell, it will come to this place. You enter, you put take profit here. Are you seeing that? So if somebody sells from here, come here. Buy from here, comes here. Sell from here, comes here. Buy from here, comes here. It will continue until this consolidation is broken. Look at the break. Now, I want you to look at the break very well. Did you see a candlestick formation in this break? Yeah, I have a candlestick formation. Yeah, I have a candlestick formation. Yeah, I have a candlestick formation. But yeah, there's no candlestick formation. That's why this market breaks through that consolidation. Can you see that? So this consolidation, this is even a small consolidation because this is a 2-hour chart. What you are looking for is you want to go to a larger time frame like this. Go to a larger time frame. Look for consolidation that can run for 1 year. And you will sell from here. And in the next 2 years, you see being the trade coming down. This is a weekly chart. You sell from here on a weekly chart. 2 years, you are still in this trade and it's still coming down. And the market is doing A, B, C, D, A, B, C, D, A, B, C, D. Until it gets to the bottom of the consolidation, you buy again. This is what the market typically does every single year in, year out. But if you look at it overall, the number of time the market consolidates is more than the number of time it trends. Why? Because the countries, they make the decision of whether the market should go up or the market should come down. So if at this point, let's say this currency is maybe USD, GBP USD, okay, that's between the United Kingdom and sorry, my mouse is misbehaving. Okay, all right. 1 minute. My mouse is okay. Not the funny thing, I cannot see the mouse. but the mouse is moving. All right, let's see. Someone explain what is happening to my mouse to me. Okay, let's see.
Mouse has not taken his own share of the cake.
Hey, sure, it used to talk like that too, you know. Okay, so let me just close this, don't save. Okay, let me open it again. All right, so just go to, so we're talking about this place. Okay. So you come to, so in this consolidation that you're seeing, this blue line is like the weekly chart. Okay. Then this small one, this green one is the daily chart. Okay, then on top of the daily chart, you have the 2-hour chart, right? So you as a trader, all it takes for you to identify consolidation is maybe 3 points. So the market comes from here, come here, and then come here, and from here the market is selling. So your reference is this is a high, the market return to the same high, and then the market starts selling. So if the market is selling, it's going to come to the next low. When it gets to this low, it's going to go to the next high. Now, the only thing that is your assurance of taking this trade is that when the market got to this low, instead of the market to break through this low and go, the market creates a candlestick formation here. And you see your stochastic is coming, is leaving the buy zone. This is what you need to see. Okay? So with this, you know that, okay, this market is going to buy. So consolidation is the easiest to trade. Consolidation is easier to trade than trend. But unfortunately, the story out there is not like that. The story is actually pointing to the fact that consolidation is more difficult to trade. But it's not true. It's easier to trade consolidation. And you still apply your ABCD. Look at it. Even though this is a consolidation, this is a large consolidation. For the market to move from A to B to C to D on this consolidation, it's still going to follow the ABCD pattern. But on the weekly chart, you are not seeing that ABCD. You are just seeing that the market is buying. Where the market is supposed to come and do ABCD, it's another movement. That's actually the consolidation. For the small time frame on top of the big time frame, it's actually trending. Offrey, I don't know if that clarifies your question.
Yes, sir. Yes, sir. Quite understood.
Okay. All right. So let's go. So basically, those are the conditions you want to see to, take the trade. For now, for the purpose of this class, okay, we said we will do the wait. We will take the patience to wait, because from the C to the D is what we describe as a push zone. So for a market that is going up, we call it up push zone. And for a market that is going down, we call it a down push zone. So we, as traders, we are more interested in buying C to D and selling C to D in both the upward or the downward move. Now, so our market will continue to move, creating A, B, C, Ds. When the market finishes the first game is A, B, C, D. When the market finishes the first game, we say the last C and the last D becomes our new A and our new B. And then we wait for the market to come back to C, and we look for a reason to trade to D. We have finished 2 games, right? So this C and D again becomes new A and B. We wait for the market to come back to C. We trade C to D. Now, if we do this 3 times, that is, we trade C to D here, we trade C to D here, we trade C to D here 3 times, and we make money. Even if we trade another 2 times and lost money, we will still be in the money. Okay, so that's what the market does. And as the market is doing this, the market keeps going up. If the market wants to go down, the market will replicate what it has done going up. The market will repeat the upward movement. It will repeat it to the downside. That is, it's still going to be doing swing of A, B, C, Ds, A, B, C, Ds, A, B, C, Ds. So in the A, B, C, D going up, you see that the market was forming higher low, higher low, higher low, higher low, higher low. Okay, the market was forming higher low all the way to go to the up. Yes, Timothy, go ahead.
So, sir, what I understand is, if we've performed 2 or 3, would I call it rationale of up down, that's A, B, C, D, A, B, C, D. We performed 2. And you said whatever the market performs upward way, it will perform downward way at another time.
That's correct.
Can we know that time frame? Because it's that time frame that actually determines profit or loss, which I think is not 100% that somebody can determine that time frame. Because you already said at the beginning of this training that you, as an individual, should know our strategy, plan your own individual strategy.
That's correct.
So do I say, okay, this up, down, and totally down, 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 down? Will it be a factor of 2 hours, 4 hours, 1 day, 1 week, 3 weeks, 1 month, 6 months?
Okay. So when we started this class, I told you guys something. I said what the market is doing on the individual time frames. Okay, take note, the individual time frames. So there's 1 hour, there's 2 hours, there's 3 hours, there's 4 hours, there's 5 minutes, there's 30 minutes. Irrespective of the time frame, the market must do this, must do A, B, C, D. It doesn't matter. So let me pull a chart out for you to see. So this is a chart, right? And this chart, this is USD JPY. Okay. So what I'm saying is this. Let me move this one down. Yeah. Okay. What I'm saying is this. There are time frames here. This is 1 minute. This is 5 minutes. This is 15 minutes. This is 30 minutes. This is 1 hour. This is 4 hour. This is daily. This is 1 week. This is 1 month. Okay. Now, all these time frames, right? This market is doing is different A, B, C, D. A, B, C, D. The market is doing A, B, C, D on the monthly. The market is doing A, B, C, D on the weekly. The difference between the monthly ABCD and the weekly ABCD is that while the weekly is doing 5 sets of ABCDs, the monthly is just doing 1. Do you understand? Because it takes more candles on the weekly than you have on the monthly. So this monthly candle that you are seeing like this is approximately 4 or 5 weekly candles. Okay. So in fact, let me okay, I cannot split this one. Let me leave this one. Okay, you know what, by the time we finish this presentation,
I get it. No, I get it, sir. I get it. It's a must. It must come.
yes.
Just that the third day it must
So
not be too clear.
so now you can decide to say, I want to only stay on 4 hours. If you are staying on 4 hours in the forex market, you will be regarded as a swing trader, right? That is, you are trading from low to high, high to low, okay? That you are a swing trader. But if you are staying on daily, if you decide to stay on daily, you will be described as a position trader. That is, you can place your trade and wait for months to take your profit. You are called a position trader. But anything 1 hour and below, in fact, 3 hours and below, you are described as intraday trader. That is, you are trading every day to make your money every day. You enter the market today, you close your market, you close the market the same day. Okay, that's what you are doing. Okay, so if you look at this market from here, the market move from year to year. So we say this is A, when we say this is B, then the market start coming to C. When the market got to the C, number one, it gave us a strong rejection. Are you seeing this long wick to the downside? See this long candle wick to the downside. Strong rejection. Then number two, it gave us what we call a bullish engulfing candlestick. This one. Okay, so you have met condition 1, you have met condition 2, okay, and then as I place a counter trend line, you pick your trend line and draw a line across these stops, okay, these stops. Now, this is your bullish candlestick formation, but your bullish candlestick formation in this case did not close above the line. So you can wait until you get a candle that closes above the line, which is this small candle here. So as soon as this candle closes above this line, this is where you want to enter your buy. Okay. And now when you put your Fibonacci from point A, which is the low, to point B, which is the high, this is your Fibonacci, right? So that comes back to what? 61.8 level. So when this market starts to buy, we are saying this market must do minimum, the minimum 161.8. So when you buy this market at this line here, when you take a buy here, you are expecting the market to rally to 161.8 level. So you draw your upside Fibonacci, and then you put a line here, and this is where you want to close your trade in the market. Did the market get there or not? The market got there. So if you have taken this trade from when you took the trade, this is 1 hour time frame. From there into the trade here to when it hits this level, it's about 36 candles. So that's like a day and some few hours. Okay, for the market to give you to put you into profit. Okay, so I'm just trying to explain. So this is the Fibonacci. Okay, this is the fourth Fibonacci that comes with the system. You remember I downloaded this MT4 in one of our classes, right? So what you are seeing is the default Fibonacci that comes with the system. So this Fibonacci can be formatted. Like if you see the one on my trading chart, it's formatted, it's showing differently from what you are seeing here. Now I can show you how to do that formatting. Okay. All right. So let's go and continue with this line. Let me close all the other slides that I've opened that are not necessary. Close. Let me go close this. Okay, close. This thing that the mouse is doing is really, really confusing me. I don't know why. It's a final solution to it. This is not the first time doing it. Okay. Okay. So let's close. Let's present as view. All right. Let me see how many slides in total. Okay. All right. So let's just go. So we've talked about this, we've talked about this, we've talked about this. So this is how the market goes. The market goes up in ABCD format and then come down also in ABCD format, right? But now the market is going up and it's going down. When it gets to where the market is going to change direction, it doesn't just change direction, right? Because remember our trend line principle. We said if we are drawing trend line, we connect our A's and our C's. You connect your first A to your first C. That is your long-term trend line. Now, when the market is going up like this, you see the market bouncing from the same trend line, continuously. So when the market wants to go down, what the market will first of all do, the market will break the trend line right here. So the market breaks this trend line. Now, that the market breaks the trend line doesn't mean that the market has changed direction, because the market can see get a candlesticks anywhere here and still go back up. But when the market breaks the trend line and it then comes and takes out this A, then the chances that the market is going to change direction is now very high. So once the market breaks the A and it starts pulling back, if it pulls back below the trend line and then starts selling, that is a confirmation that the market has changed direction. Okay. And now I also showed you this some time ago. I said if the market is changing direction, the market forms the shape of a crown. That is, it does an A, B, C, D price swing to the up, and then another A, B, C, D price swing to the down. Now, watch the beauty of the A, B, C, D price swing. When it does the A, B, C, D price swing to the up, the A, B, C, D price swing to the downside, the B must be below this C here, this one, because if it doesn't break this point, the market will not change direction. So this B of the down ABCD must be below the last C of the up ABCD, and vice versa if it's going to change to up direction. So I said you are going to see the shape of a crown. And this shape of a crown, if it's a vertical crown, the market is changing from buy to sell. If it's an inverted crown, the market is changing from sell to buy. Remember, A, B, C, D up, A, B, C, D down. Here is A, B, C, D down, A, B, C, D up. Okay, so just take note of these two structures. Okay, so when the market now breaks and it has formed the crown, what you will do, you are now going to start connecting the down trend line. So this was the up trend line that was broken with the A taking out and the market pulling back behind the trend line. And this now gives you the down trend line. So the market will now stay below the down trend line going down. So if the market is going to go up, we'll see a crown like this. Left tip, center tip, right tip, buy. If the market is going to sell, left tip, center tip, right tip, sell. Left tip, center tip, right tip, buy. Just cram it on your head that this is the formation you will see if the market is changing direction. Okay? And if you look at the market, you will see that now it is the crown, they are not symmetrical. Okay? So this is left tip, center tip, right tip, buy. Left tip, center tip, right tip, sell. Left tip, center tip, right tip, buy. Okay, you are going to see it crystal clear. Now, for the time frames, I normally do the analogy of a mother and a child in the womb. The mother and the child that are in the womb who ultimately determine where they should go, who ultimately determine where both of them will be at a time. Is it the mother that is carrying the baby in the womb, or is the baby in the womb that will control the mother to say go here or not go there? What do you think?
The mother.
Mother.
Okay.
The mother.
All right, thank you. So I also think it's the mother, right? Now, because wherever the mother goes, that's where the child will go, because the child is contained within the mother, right? So that's the same thing that happens in forex trading. So when you hear daily time frame, monthly time frame, weekly time frame, inside the monthly time frame, you have weekly time frame. Inside the weekly time frame, you have daily time frame. Inside the daily, you have the hourly time frame. So irrespective of what the market does in the 4 hour or the 1 hour or the 30 minutes time frame, it doesn't matter. It is where the daily time frame close, that is where the market will go to. It's possible that inside the daily time frame, because now inside the daily time frame, I have 24 hours of 1 hour candlestick. I have 24 of it inside one single daily time frame. So that daily time frame is what will determine the direction of where they will go. So now, for us to understand, which remember this is A, B, C, D. While I was trying to explain to Timothy just now, I made reference to the fact that the A, B, C, D in the monthly will take a longer time to form as compared to the A, B, C, D of the weekly. So what you are seeing is the monthly A, B, C, D. I want you to take note, specifically take note of where they started from. Okay? I want you to mind this place, the A. There's also everybody, 1 minute, 10 minutes, 15 minutes, 1 hour, everybody starts from the point A. So it's just like a race, right? The race starts from here, A. As soon as we start the race, everybody go, we blow whistle. Everybody starts running. Now, as soon as that race starts, this is monthly. Monthly is looking for B, right? Why monthly is looking for B? Before monthly we get to is B. Weekly has already found the B. Okay? Weekly already found the B. Look at it. So both monthly and weekly, they started from here. And weekly already found the B here. Monthly is still moving, going to look for B. It has not seen a B. Okay? But weekly has found the B here. and now weekly is looking for C. Meanwhile, monthly is still heading to B. Then gradually, weekly finds a B. Left tip, center tip, right tip is my, sorry, C. Weekly finally found a C. Left tip, right tip, center tip. Center tip is your C. And then you say buy. Now, remember, monthly is going up. When weekly now sees a C, a candlestick formation now shows up on weekly that lines up with the monthly that is going up, you take a buy. The monthly will now help you to push the weekly up. Remember, monthly has not gotten to its own B. Monthly is still going to B. But now weekly has found a B, and weekly has completed one price swing, A, B, C, D. And then weekly looks for another C, goes to another D. Monthly is still what? Is still looking for B. It has not even seen B. All right. And then we say the daily, all of them also start from the same point. The daily finds its own B even before the weekly. So while the weekly is moving from A to B around here, daily has already found a B here, and then a pullback that breaks a counter trend line that buys in the direction of the weekly. But remember, monthly is going up. After the C, daily starts going up. Meanwhile, weekly is going up. So what you are looking for to trade is where you see these three going up the same direction. So first, you are able to establish that monthly is going up. So I want to trade all the C to D of weekly and all the C to D of daily. As if that is not enough, we add one more time frame, the 2 hours time frame. So the 2 hours time frame is this small green on top of the daily. Okay. So your best bet to enter this market, and when you enter this market, the likelihood that the market will come against you is when you find all of them going in the same direction. Now, I want you to understand that, let me take it back one step. Let's go back one step. Let me use weekly and daily and monthly. I mean, it's clear enough. Do you see that when this weekly, when this monthly is going up here, the black line, the weekly is coming down here. It's coming down here. It's coming down here. So what you want to do is you want to find monthly going up, and then you want to find weekly going down against the monthly going up. But you're not going to trade that. You will wait to see that the weekly has finished coming down against the monthly and has realigned itself with the monthly going back up. Whenever you see that, you can pull your trigger and start buying in the direction of the monthly. This is talking of weekly chart now. You need to do that with the daily chart. You need to do that with the 4-hour chart. So when you see all of them lining up in one, going to one direction, that is where you want to enter the trade. Now, how do you see them? The question is, how do you see them? The question is simple. We said from the beginning of this class that your A is a low. And this your A is 2 candles to the left, 2 candles to the right that are what? That are higher than center week low. Okay, so that is your support. If you flip this chart to your normal chart, okay, and then we switch to a monthly chart, you can see our 1, 2 to the left, 1, 2 to the right that are higher than the center week low. So let me put this line here. Bring this line for me. Bring this line here. So this is a low, right? This is a low. From this low, this market starts to take off. I want you to specifically notice this place. Notice this place, right? I just want to do an explanation based on what I just explained. Now, everybody takes off from here. 1 minute is here, 30 minutes is here, 1 hour is here, weekly is here, daily is here. And then I switch this market to weekly. Zoom it down a little bit. Can you see it? Look at the weekly. Are you seeing it? Look at it here. Let me see, zoom it down a little bit here. Can you see? This is the point that we are talking about. This is our, look at the price, 127. If I switch it to the monthly, look at the price, it's still 127. This is the 127 level, this level. So now when we flip it to weekly now, flip to weekly. As we flip to weekly, it's still the same price level, right? But the weekly has done A, it has done B, and then it's coming back to C now. So this is the coming back to C. So if we put a trend line there, if we put a trend line here, okay, a counter trend line, that this market is coming back to C, the market is looking for C. Remember, if we flip back to the monthly, we have not seen ABC, right? Yeah. So this is, in the monthly, we have 1 candle, 2 candle, 3 candle, 4 candle, 5 candle going up, right? But then in the weekly, when we bring it back from the same place, we've had 1 candle, 2 candle, 3 candle, 4 candle, 5 candle, 6 candle, 7 candle, all of them going up. And then the market has hit a high, 2 candles to the left, 2 candles to the left, coming down. And then we say this coming down, this our coming down we're talking about now, is this one, is this coming down here? This, okay, let me take it to the weekly one. Yes, this coming down. And this what we started from here. Weekly has moved to here. And then we are coming down here now. Okay. I want you to pay attention. Now we are coming down here now. So if we draw this our line, this is our big monthly going up. The monthly is the big line like this going up. Okay, then the weekly is one small line like this going up, come down, goes up, come down, goes up, come down. Okay, so by the time the weekly comes down here like this and finds a candlestick formation. Here is the candlestick formation. The candlestick formation is going to appear here on your chart. So you see the candlestick formation and you see that it's actually break that counter trend line. Then you want to trade the market to D. So you're not going to enter the market here, buy the market from this candlestick formation, and the market will now go to D. And with our Fibonacci, we can actually estimate where our D will be. We said our D will be somewhere around 161.8. So for the default Fibonacci, all you need to do is to take it up and draw it down to get the extension level. So you draw it down to your C, you get the extension level. So this is A. There's also another tool that is called the Fibonacci extension tool. If you come here, you can put this place. I come here, costume. I can come look for Fibonacci extension. So I go to Fibonacci retracement here, and I look for the Fibonacci expansion tool. Where are you? Fibonacci expansion. And then I say insert. So now this is the Fibonacci expansion tool right here. So instead of doing this tool, I can pick only the expansion tool, and I say this is my A, this is my B, then I draw it to C, and then we look for where is 161.8. This is 161.8. So the market goes to 161.8 minimum. And the market actually did that. Okay. All right. So I'm just showing you. So this might confuse you, right? With time, you understand it. So the same way we have Fibonacci retracement, we have Fibonacci expansion too. Okay. So but now I just want to believe that you understand the concept. So the market has done A. Everybody starts from A, but Weekly has already gotten to B because it has formed 2 candles to the left, 2 candles to the right. Okay, and then it pulls back. Then it form another 2 candles to the left, 2 candles to the right, and that gives you the opportunity to buy. So when you are buying this like this, you are actually buying it in the direction of the monthly. So now remember, we still want to trade C to D, right? Now we have C to D on weekly. On weekly, we have C to D that we are trading. But monthly is still going from A to B. So our best trade will be when we are able to identify that monthly has done A, B, C, and then inside that the C, when you locate the C of the monthly, you now look for a weekly A, B, C. After that, you look for a daily A, B, C. Okay? So what you want to do to get the most accurate entry that you will not lose your money is you don't need to bother yourself when the market is trying to do all this change. So what I want to do is I want to locate my ABC monthly. Remember, my ABC monthly means that I would have had 2 candles to the left, 2 candles to the right, which is 5 months of movement in the market. 5 months of movement will give me my C of the monthly. Then I will now look for the C of the weekly. Now, the daily C that will break the weekly C, that will break the counter trend line on the weekly C, is what we want to use to enter the market. So when we enter the market, yeah, we buy this. Remember, this is weekly C on the monthly. If we buy this weekly C with our daily will run and give us D. We'll close our trade. We'll wait for the next one again. It will run and give us D. We'll close our trade again. It will run and give us another D. We'll close our trade. And now this time, the market did what? Break the trend line. Are you seeing how your weekly is adding a trend line to your daily? Your monthly is adding a trend line to your weekly. Your daily is adding a trend line to your 4 hour, your 3 hours, your 2 hours, your 1 hour, all the way to 1 minute. Okay? So once you're able to identify this spot, this is what we call the sweet spot in the forex market. The sweet spot. So once you're able to, now I want you to also understand that this thing doesn't happen in minutes. That's why a lot of people, that's why people call forex game. See the energy, the time we are putting to explain this concept. Some people don't even want to go through this explanation. They just want to jump into the market and trade. You will lose your money and call it a game or call it gambling. When you don't take time to carefully do this, once you have carefully do this, once you have carefully done this, it's easy for you to put a trade and go to your work, whether you are working in Shell, Chevron, Jobless, Alibotin, you don't care. Go to your work and sleep. Your money will be working for you. Once you can do this, your money, you can just go, you can imagine that, see, let me shock you. Imagine that you are able to draw the Fibonacci. You draw the Fibonacci on this A monthly, this B monthly, and then you allow the market to pull back to 61.8 retracement level on the monthly chart. And then you are able to enter from the 1 hour in this place, and you are going to close your trade on the 61.8, the 161.8 of the monthly chart. So you enter from here. So you buy or sell and take your profit from the D extension of the monthly chart. Meanwhile, you are using the daily chart to enter. But if you want to be a scalper, you can say, okay, I've entered here. The market has reached the daily P. Close your trade. Wait for time to enter again. Close your trade. But you can just enter one big trade here. All this waving up and down will no longer be your business. Every time the market wave down weekly on top of daily, you add another position. You wave weekly on top of monthly, you add another position. in this movement now, this one movement from C to D of the monthly is 4 movements of C to D on the weekly. So a move here, C to D, 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 4 times. Meanwhile, the monthly is just doing 1 movement to the D. Tell me, does this explanation make sense?
Yes, sir.
Is it bringing some
Yes,
kind
sir.
of clarity to what you know already?
Yes, sir.
So, will it be advisable that we do weekly than doing monthly?
Okay, so there's also what we call, let me see if I did it here. Just 1 minute. Let me see. I'll come back to the yes. Perfect. Chart relationship. If you are using your 2 hour as your trend time frame, let 15 minutes be your entry time frame. If you are using your 1 hour as your trend time frame, what we do is we divide the trending time frame by 4. Somebody that person should mute himself. Okay. We divide the trend time frame by 4, okay, to get the trigger time frame. So this is your trigger time frame, okay, while this is your trend time frame. So if I'm analyzing, so maybe I want to make money quickly, instead of me to go and be analyzing weekly and coming to be trading on 15 minutes, I'm making a big mistake, because the relationship between weekly and monthly is far. If you see what I've done here, if you see what we've done here, you see that the relationship between daily, look at it, daily and monthly, because there's weekly in between, that relationship is far apart. Do you understand? So it's not going to give you accurate results. But if you do a relationship that is close, so this one is 2 hours, 15 minutes times 4 will give you 2 hours. Okay. 60 minutes. This is 4 hours. Okay. So if you look at this 4 hours time frame, you want to come and trade on the 1 hour time frame. Then when you look at daily, you can actually trade on 2 hours or 4 hours or 1 hour. Any of these 3 can work for daily analysis. Why, if you are looking at weekly, you want to trade daily, and if you are looking at monthly, you want to trade weekly. So you need 2 time frames for your analysis, 2 time frames. Some people want to do 3, but sometimes when you're doing 3, it makes it more complicated. Like this is 3. So I'm looking at monthly, I'm looking at weekly, I'm looking at daily. Now, where this 3 matters is larger time frame control price movement on the smaller time frame, because when this market moves and get to D, remember, all of them, all the time frame are getting to their D, the same time. When this market gets to D on the weekly, at that same time, there is a corresponding D on the weekly, monthly. There's a corresponding D on the weekly, and there's a corresponding D on the daily. But now, if all of them go to D at the same time, but when they start moving away from the D, you will see that the daily will move first, because the daily will come and break the weekly, which is acting as a trend line to the daily, breaks the weekly, then takes out the A, and then pull back behind the weekly trend line, and then the daily, the weekly will come and break the monthly. Okay. Remember, as the weekly is breaking the monthly, the daily is still doing its A, B, C, D, A, B, C, D below the weekly. Okay. And now that breaks the monthly, and then the weekly pulls back below the monthly, acting as a trend line for the weekly, and then the market starts to sell. So each of these turn, there is a crown formation. Yeah, there's a crown formation. Yeah, there's a crown formation. Yeah, there's a crown formation. Every of the turn is a crown formation. And I want you to also note this thing on your weekly chart. Anytime you see a candlestick formation on the weekly chart or on the monthly chart, okay, let me rephrase my statement. Every time you see a candlestick formation on the monthly chart, you have a reversal on the weekly chart and the daily chart. I don't know if you understand me. So let me jump to the chart so that I can explain it better. So this is the chart now. Okay, this is weekly. Now let's go to monthly. So this is monthly. Now, beautiful. Look at this monthly chart. I said anytime you see this is a bullish engulfing candle, right? Bullish engulfing candle. This bullish engulfing candle on the monthly chart, on the daily and the weekly chart, is a reversal pattern. As in, the market has already reversed. By the time this candle is closing here, this close here, if you look, okay, so let me put a mark there. This close here is a reversal on the weekly. Are you seeing that? It tells you a reversal has happened. A change of direction has happened. Then if you now bring it to the daily, I'll compress it a little bit further. You look at it, you look at the daily. The market has gone, has created A, it has gone to create B, it has come back to create C, and then it has broken above the previous B, and then the market will continue to buy. Does that make sense?
Yes, sir.
So this is exactly what the market is doing. So most time, where traders have problem is everybody want to come here, 5 minutes. They want to put a trade here. Look at this chart. This same chart, and I be this way, they well aligned. Okay, but look at it on the 5 minutes. Look at it on the 15 minutes. It's crazy. Look at one candle on the 15 minutes. One candle. This thing happened last week. Okay, so you need to be able to analyze the market applying this principle. Applying this principle. Okay, when you apply this principle, trust me, you will at least 70% of the time to 90% of the time, you will be right. You will be right in your decision or in your analysis. Okay. So most time, what you want to do is you want to see where the market are eating the Ds, where they are getting to the Ds. When did the daily get to D? When did the weekly get to D? This is what you want to see. So this is the chart relationship. Can make a note of it. And then I said where you want to enter the market is when you see everybody lines up in the same direction. Monthly, it's going up. Weekly, it's going up. Daily, it's going up. 1 hour to be going up for you to start trading. Okay. If all of them lines up going up, that is when you want to take your buy. If all of them lines up going down, that is when you want to take your sell. If all of them lines up, let's say you have one going up and 2 of them going down, you don't want to take a trade. You know, so I mean, just so look at what I was trying to explain to you. Now, this is the monthly time sheet, time frame A, B, C. From the monthly time frame, now you want to start to the buy. You want to buy to the D of the monthly. So you can start buying counter trend line break in the direction of the monthly on a smaller time frame. So when we do, so you know, sometimes this is where for those of you that are already trading, this will benefit you better. So if you come here, when we saw this, right? For those of you that are traders already, by virtue of our thoughts, by virtue of our knowledge, somebody will say, oh, this market price is too high. I should not take a trade. Let's be watching out to look for a sell. But no, you know why? Because this is a low. Because the market creates this as a low, the market must go and create a high. I want you to look at this chart. Look at this place to this place. If in between this place we have any high, there's no high on the monthly. Look at it. This 1, 2, 3, 4, 5 makes this place a low. 2 candles to the left, 2 candles to the right, higher than center wick low. In this movement like this, there is no other one like that gives you 2 candles to the left, 2 candles to the right that are lower than center wick high. None. The only time you got it is here. When you have this, this, and this, then this and this lower than this place. That's when you have a resistance. So when you see this resistance, it means that the market is pulling back now. It's looking for a C for the monthly chart. So what you need to do, once you have ascertained this, all you need to do is to switch back to a lower time frame. It's clearer with the monthly. Okay, so when we switch back to the lower time frame, we want to buy the counter trend line. So yeah, the counter trend line. This is the first one. Counter trend line break. You can move it until it gets to the body of the candle that is coming from the bottom. Okay. Yeah, we have another counter trend line break here. Okay. Counter trend line break. Here we have counter trend line break. Now, let me also educate you on one thing, one very important thing. When the market pulls back, remember the word of Sokyoma. In our very first class, I talked about Sokyoma, the Japanese trader. Okay. When this market pulls back, I want you to take note. If you do not see 3 minimum, if you do not see 3 bearish candlesticks, please do not draw counter trend line. One of the conditions for you to draw counter trend line is that pullback must show at least minimum 3 bearish candlesticks if the market is in an uptrend. Then if the market is in a downtrend, you must see at least 3 bullish candlesticks. It doesn't matter the order. We can have bearish, bullish, bearish, bullish, bearish. It doesn't matter. Okay. Provided for this pullback from when the market formed this high and is coming back, but it didn't get down to this low here. It didn't get down to this low here. It's coming back. Okay. Draw a counter trend line once you have seen 1 bearish, 2 bearish, 3 bearish. Just connect the eyes of those bearish lines and leave it there. If the market comes and close above that line, that is your trigger to continue to buy. So this one I did 1 bearish, 2 bearish, see the 3rd bearish, 3 bearish. Yeah. If the market breaks above this line, start to buy. This is 1 bearish, 2 bearish. So you draw 1, 2, 3. The market breaks above this line here, start to buy. This one is 1, 2 bearish. So you don't need to draw a counter trend line on this, because the market did not meet the criteria, the bearish criteria that make you to say it's a pullback. But this one, where you have 1 bearish, 2 bearish, you can say this one is the 3rd one, and you can draw a counter trend line. Okay. In that way, when the market breaks for this candle, you can still take this movement point and make some profit. Is that clear? So when you switch
Yes,
this,
it's clear.
if you switch this guy now to daily, you will see 1 bearish, 2 bearish, 3 bearish. Put a counter trend line there and wait for the market to come and break that counter trend line. Market breaks it, tests it, boom, and it took See the movement here. Breaks it, came back, test it. Market run with, that's about 470 pips in 13 days. 13 days, 470 pips, one lot or two lot or three lot. That's so much money in your account. Okay. One bearish, two bearish, three bearish. Draw your counter trend line here and wait for the market to break. You buy the market and the market run from here. At this point, the market has not taken out this high. So the market is still buying at this point. This additional trade, why you enter this trade, when the market did this and break this, you can add additional trade here, and all of them will move all the way to this top with 708 pips. Okay, so here you have 708 pips. The additional trade you enter here add 475 pips. That's a total of 1,115 pips. You can start this market. Watch this. You can start trading this market from this place, and you will be in the money. So imagine somebody that took this trade. Imagine somebody that took this aggressive trade from when this bearish candle closed, and you enter aggressively. Say, all die and die, this market must buy. And you follow this market to this point. That's 2,800 and something pips in 15 months. 15 months is like 1 year, 3 months for almost 3,000 pips. Let's say you do that trade with five lots. Oh, somebody is smiling.
Not with small equity. Oh.
And you want to make money, you have to have money to make money. You just like as I'm teaching you now, I'm teaching you this topic, right? Now, if you are very diligent and you go to demo and start practicing these things that I'm talking, and you start making results, let's say you start your demo account with, remember this account, it's your present. I created this account that day. I use this thing to show you how to open MetaTrader 4, right? And when I open it, it was $10,000 that they credited me, right? I only traded this account once, only once. Look at the result. I traded this one. I took one lot into 5 places, and this is the result. So I made $1,868 in just how many hours of trading. And see, the original money that they deposited was 10,000. I made 1,868, and the balance of the account now is $11,868. I've not traded this since that time, since after that day. Okay. So you can see it's a fresh account. Nothing has happened. Only one trade has happened on this account. Just only one trade. And this is the profit of that trade. So if you come here and take what's it called? The equity curve now. If you want to take the equity curve of this chart, you come here and you say report. Let's just say okay, let's use Internet Explorer. Okay, let's see the reports. I'll just say save to desktop and open. So this is the report of the trade. So this is your report. You can see my name is there. It's a demo account. So we just want to look at the equity curve. Straight line up. This is what you want to do as a trader. This is the kind of result you want to get. By the time you trade another one like this, you see this thing just a upward slope, continuously sloping up. Meaning that you're making money.
Okay.
Okay. All right. So I think we can finish this thing because we have about 15 minutes. And that reversal, I can do it in 15 minutes. So let me bring up that that reversal because this one is already finished. Let me see. That will apply. Just play like this. So, okay. So that's it. At the end of the presentation. Okay. Any question? I'll just do that reversal quickly so that okay, this thing normally happen on the Explorer. I think I understand what's going on now. All right, so let's close
I have a
this.
question. Hello.
Go ahead, please.
Yes. So I want to ask, which is the best time frame for intraday trade like a swing trader? What? Because I noticed was it on Thursday last week there was a very big jump. That's the British pounds and the dollars. There was a very huge. There was a spike there, and all of a sudden it started going back. So is it better to just take your profit when you have that spike, or if you don't take a profit at that time, where are you going to? Is it going to counter all because the market is fighting both ways, is going positive and negative. So I don't understand which is the best time to take your profit. Or for example, you said you can go to bed, put your trade there, put your trade, and you can go and relax and expect that you're going to make profit. But sometimes the way the bulls they work, the bears they tend to counter that drive. So is it safe to go to bed, or you just have to monitor your trade?
Okay, so I'm displaying on my screen the Forex Factory economic calendar. Can you see it? Can you
Yeah.
see? Okay, good. Now that problem, that thing you said now happened on was it Thursday or Friday? So let's just backtrack a little bit. This is let's go to Thursday. Thursday apply. Thursday. All right. Did you see? You saw this news on Thursday, 11th, 1:30 p.m. Nigeria time. The U.S. unemployment claims was released. This was the forecasted. This was the actual value that was released. And when you click on this folder, it will tell you the report that the effect of this news is that the actual less than forecast is good for the currency. Okay. Then the effect of this news, the next one, is that actual greater than forecast is good for the currency. And the effect of this one is actual greater than forecast is good for the currency. And then the effect of this one says actual greater than forecast is good for currency. So that spike that you are talking about that happened, now you are just trading. You probably did not know that this news is going to come out. Okay, so that's why sometimes you look at the news. If you are trading on the higher time frame, from the daily time frame to the monthly time frame, you don't need to bother about the news. But if you are trading anything, swing, intraday, you are at the mercy of the news. Now, I want you to look at this chart carefully. Can you see this chart?
Yes.
Now, this chart, I will switch it to 1 hour so that you see the effect of that news on 1 hour. Look at 1 hour. Are you seeing it?
Yes.
But if you come to monthly, did you notice it there?
No.
You come to weekly, did you notice it there?
No.
Or daily, you won't notice it there. Okay, you can see daily, even the big drop on the daily, it came back to previous resistance. It has not broken the previous resistance. So this is more like previous resistance becoming support. So even though it has done this push back here, next week you might be surprised that this market will rally from here to go up. But if you come to 1 hour, it's disaster. If you come to 30 minutes, it's killing. If you come to 15 minutes, it's dead. You see? So you that is doing intraday, this is where you suffer. Maybe, look at this, oh, maybe you have come and said this is your A, this is your B. The market created what? A C. Because this arrangement, bearish candle, indecision, bullish candle, this is morning star arrangement, right? So market has
Yeah.
given you turn, coming from a very good place, and then all of a sudden, boom, after you have already entered buy, you will just say, in your mind, you just say, these brokers, they were just waiting for me to enter so that they will collect my money. Do you understand? All this Iggy Haga that is happening here, if you switch this thing to daily, it's minute. If you switch it to weekly, barely noticeable. Monthly, you will not even see it. You see, your monthly is still showing you that the market is buying, is buying, is buying, is buying. So you will not even bother. Because in the monthly, you want to buy from low, right? So you are looking at buying from low price here, you know, you are looking at low price to take your trade. All this place are low price, low price, low price, low price. So from this low price, this is where you buy. So this is a high price. So you will not buy, and you will not put a trade. The market will still be going in your direction. So that's what happened that last week that causes that, that shake in the market. So you need to be able to read the economic calendar. If I come here to my filter here, I can say, show me everything. So if I say, take this, take this, take this, and I say apply filter, you're going to see so many things. Look at them, so many news. The news are plenty in the forex market at different times. But what you need to know is that all these colors that are ordered, any color other than red, they have less effect on the market. So I don't want to bother myself with these ones. I don't need them. So all I do is just to hide all of them so that I don't see them. I don't want to see them. So I turn all of them off, and I only want to see, the only one that can shake the market is this one that is red. Okay, and I say apply filter. So it shows me only the red. So red means high impact, means that the impact of the news is high. So like all this one, I will say this greater than forecast, good for currency. This was the last, the forecast was 0.2 and what came out was 0.1. The forecast here was 0.1. What came out was minus 0.1. The forecast here was 3.1. What came out was 3.0. And then here was 236. And then what came out was 222. So this one, less. This less. This less, because this is less than this, is good for currency. Why? Because this is unemployment, meaning that the unemployment claims were less. We don't want to have plenty unemployment. We want to have reduced unemployment claim. That is, the number of people getting jobs should be more than the number of people that don't have jobs. That's what will propel the economy forward. Okay, so that's what this thing represents. So you need to be able to, you can pull this calendar, you can see all the way to a far distant time. Look at which day is this? This is 24th of July. these are the news that you expect. These are the figures that will be, these are the news that will come out. 19th of July, these are the news that will come out. Remember, some of these news, they are quarterly, some are monthly, some are yearly, okay? Now, one thing I want you to know, if the news, so when you see M/M, it means month on month. When you see Y/Y, it means year on year, meaning that this news is coming like once in a year. Every news that comes once in a year, they have a very strong potential to move the market largely. Okay. While those that come on monthly basis, on daily basis, on hourly basis, they may not move the market so much. But the biggest of them all is the NFP. That's the employment figures of the United States on a monthly basis. So if the United States creates more jobs than forecasted, it will bring strength to the US dollar. And then you see the US dollar driving every other currency, haywire in the forex market. So apart from knowing the technical analysis, you need to also have an idea of fundamental analysis or macroeconomics. Okay. These are macroeconomics figures, okay, that changes and affects the market. Somebody posted something this morning. He said this assassination attempt on Donald Trump may lead to the market getting weak or something. Okay, yeah, I mean, it's possible. Okay, it's very, very possible. Somebody can, because you might wake up tomorrow now and see the US dollar, behaving somehow, cruel to the Naira, and you'll be amazed that the Naira is now going for $1,800, 1,800 Naira to a dollar. You may not understand why. Because of incident like this, just like this one that happened to Donald Trump. And you see this guy, the president of this guy, this is the European Central Bank. When you see ECB means European Central Bank. Anytime the president of the European Central Bank speaks, the values does not really show. You will not see the values. But all you need to do is just to note the time. You know the time, look at that same time, and you see what will happen in the market. His speech are very weighty. And his speech carried a lot of weight. Okay. So you need to have that at the back of your mind as you are trading. All right. So lastly, lastly before we close. So it's just a few slides. So we know there are several chart patterns, that people display everywhere in the forex market. And one of those chart patterns that is, that has, made way over the years, is the head and shoulder pattern. So the head and shoulder pattern is a reversal pattern. Or the FSA King's Crown is a more accurate reversal pattern as far as I'm concerned, and as far as the forex go. It's nothing other than what I have shown you. The King's Crown. I show you crown when I was talking about changing from buy to sell. So it's a more accurate way to identify that the market has changed direction. If you go through head and shoulder, you are going to probably be talking about neckline. The market needs to break the neckline first before the market. But in King's Crown, you don't need to consider that. All you need to consider in the King's Crown is that the market has taken out the A. Okay, and that's what I want to explain to you now. So this is the bearish King's Crown. The market is going A, B, C, D to the upside. Now, why the market create A, B, C, D at a point where you expect the market to create C and go to A, it didn't do that. Instead, it breaks the trend line. When the market breaks the trend line, it's an indication that something is going to happen. But then, remember, I said when the market has formed A, B, C, D, your C become your A and your D become your B, right? And this D, apart from it becoming your B, it can also become your A to the new direction, to the other side. Okay, so if the market is changing direction from buy to sell, this your D is your D of the ABCD price swing, is your new B in the new ABCD pricing that is going to form. But if the ABCD pricing did not form, is your new A for the new ABCD price swing to the opposite direction. Okay, so from here, if the market now breaks the trend line and takes out the A, remember by the time the market formed D, you are going to automatically label this AB. Okay, so now the market has done AB, so you're expecting the market to do C to go to D, but the market did not do C to go to D. Instead, the market came and break the trend line and then takes out the A. When the market takes out the A, pause. Something is going to happen. The market is going to rally back to the back of the trend line, and then the market will find a candlestick formation that will change the direction of the market to sell. When the market does that, you are now going to draw a trend line from this A, which is a new A now, to this C in the down direction. At that point, you say the market is 100% bearish. When the market is going up, it's 100% bullish. When the market breaks the trend line, it becomes 50% bullish, 50% bearish. When the market takes out the A and rally back to look for a candlestick formation to come down, it becomes 80% bearish, 20% bullish. And when you now draw the trend line across the A and the C, and the market takes out this B and comes back to the trend line, you say the market is now 100% bearish. That is how the market changes direction. So these are the talking points. The market breaks for the uptrend line. The market takes out the up capital A of the major support that makes up the lower low, and then the market finds a BI behind the trend line. So when the market finds a BI, what you're going to do, you draw a horizontal line from the left tip. What are we talking about here? This is your left tip. Draw an horizontal line here. The market is probably 90% of the time going to find a candlestick formation around this area to begin to sell the market. Okay, so when you draw that trend line and you draw that horizontal line, the market is going to probably create a C around that region. After C has formed, and after the market has made a new low, connect the new downtrend line, and then your market is now bearish. So these are the 6 ways the king crown is formed. In some cases, this your left tip and right tip will just come from the same level. While in some cases, the left tip will be higher than the right tip. Some cases, the left tip will be lower than the right tip. In some cases, the two tip will be low, both the left and the right. When we say low, it means that if you draw a trend line here, this is usually 61.8. So anything below 61.8 is a low tip. Okay. And then you can have a low tip and a low tip to the right, and also a high tip and a low tip to the left, to the right. So when you see all this condition, your market has changed direction and your market start to sell. So if the market want to buy, the market will do exactly the same thing that I've explained now, but now in the opposite direction. Okay, so the market will going down ABCD. The market breaks the trend line, condition number 1. The market takes out the A, condition number 2. The market pulls back to the left tip, the right tip, sorry. So this is your left tip. Draw a line, horizontal line, and the market pulls back to that left tip, and then it finds a candlestick formation, and that becomes your buy entry. So exactly the same thing I talked about the bearish direction is that the market breaks the downtrend line, market takes out A, okay, and the market takes out the A, the market is going to look for the BI, but all you need to do is to draw an horizontal line, okay, from the left to the right. Then the market will find a C, which is usually a candlestick formation, and then you now draw your up trend line. In that way, market will start to buy. So the same way you have six ways of the market doing this, where you have the two tip, left tip, and right tip coming from the same level. This level is usually 61.8 retracement level. Then you have where the left tip is lower than the right tip. The left tip is higher than the right tip. The left tip and the right tip are high, but they are equal. And then you have a low left tip and a way higher right tip. Also, you have a high right tip and a way higher a left tip and a way higher right tip. So these are the six conditions that you also find. So that is the way we trade what the reversal. All right, so that brings us to the end of the talking. So let's go to question and answers. You have questions? Floor is open. Thank you. Anybody with question? Let's take them.
Okay, my first question. Before you get to every trending stage, for example, now when you do the ABCD, right?
Yeah.
Would there be a consolidation before, like let me say, if you want to retrace, is it compulsory to be like a consolidation? Then you now retrace back before you now move, or it only occurs in reversal, or it just in different forms?
So there are a lot of concepts in the market, right? But I want you to look at it from this ABCD approach. Now, the consolidation that we talk about, where I said we have large and small consolidation. Every time your market, see, let me give you an example. See this market. This is a high, this is a low. Every time your market forms a high or a low inside the AB boundary, that's a small consolidation. Okay? Because there's a high, there's a low, okay, in between the AB boundary. So meaning that the market did not go and take, like this market now, the market did not go all the way to take out this high, right? So what you see here is a small consolidation. So a lot of the time, the consolidation happen maybe because a fundamental announcement is about to be released, or maybe there's something fishing in the market, right? So you now start seeing the market consolidating. But it's not every time. It's not every time that before the market trend is consolidated. So if you look at the phase structure, there are school of thought that says, okay, the market go into consolidation phase, the market breaks out of the consolidation and the market trends, and then the market enter consolidation phase again. For me, it's just a case of the market pulls back, market trend, the market pulls back, the market trend. Okay, so it's not a big deal, right? So you can look at it from that perspective that, okay, before the market trend, there's consolidation, but there are many instances. There are many instances where there's no consolidation. So this is a live chart we are looking at now. The market just opened now. Okay, this is a live chart. This market moves like this. If you look at this movement from year to year, even though the push are not so much, but it's not consolidating. You are seeing that the market is creating low, creating high, creating low, creating high. You are seeing it. But when the market does like this small place here like this now, you can say this is consolidation. The market neither went up, neither not come down at it. You can say this place here is consolidation. So the market breaks to the left, to down of the consolidation, eventually come back and break to the upside of the consolidation, and then the market rally. Okay, so it's not every time you will see that consolidation the way you probably would think you see it, but yes, the market, if you go to the market cycle, you will see that there's a time that the market consolidates, which is usually the rest time. And I also want you to know one thing about consolidation. Every time the market consolidates, trust me, 90% of the time, the market will break out to the direction of the previous trend before the consolidation. So if the market was trending up and then the market now switched into consolidation mode, the chances that the market will resume that uptrend when that consolidation is over. 90% of the time.
Thank you. Thank you very much.
Okay. So I don't know if that clarifies your question.
Yes, it does. Thank you. Thank you very much. Thanks.
Anyone hear me?
Sir, my name is not on that WhatsApp group. I'm not in that WhatsApp group. Please. I've said it before. I don't know if you can still re-add me back to the WhatsApp group. I don't know. Hello, sir. Can you hear me, sir? Hello?
Hello, can you guys hear me?
Yes, sir.
Yes, we can hear you, sir.
Yes, we can hear you, sir.
Yes, sir. I can hear
Okay.
you.
All right. So what I was saying the other time when I was trying to explain consolidation is you can come to the weekly chart like this and you look for where the market is consolidating. So let's see any possible consolidation. Just looking for a place to do an example. They wanted to, if you understand the zero USD. This thing is not. It's slow to load. Let's leave that USDJPY that are loaded well. Okay, so do we have any further question? Another question?
I don't know if it is too late or maybe we'll do it next class. I would maybe like you to interpret or called a leg of a trade. When I mean a leg is a movement that will now form a reversal using, for example, 4 hours and let me see 1 hour as an example. You know, when it moves from one place, from one location, even though it forms consolidating candlestick, it still moves up and later on now reverse back down like the leg. That maybe that would help on how to read candlesticks very well. Thank you.
Okay, so one thing you first need to do is to be able to compress the chart like this. You know, when you compress the chart like this, you'll be able to see previous low. So when you compress the chart like this, you are going to be seeing previous lows, previous highs, you know, where the market has passed. But now for the purpose of analysis and for the purpose of, you know, taking the trade, there's also something that is called score a point pullback. Okay, there's a concept that is called score a point pullback. I tried to explain it to you guys before that if you are standing in front of this chart, remember the chart is moving, it's moving from the right to the left, right? Moving to the left. Sorry.
From the left to right.
And from the left, it's moving from the left to the right. Okay. So if you are standing in front of the chart, I want you to look to the left. Okay. When you're looking to the left, you are going to be seeing the history, that is previous action that the chart has done, right? Now, I say when you are standing in this front of this chart, yeah, there are things you can see and there are things you cannot see. Anyone you cannot see is not relevant in your analysis. Do you understand? From here now, I can see this eye. If I'm standing here, I can see this eye. I can see this eye, but I cannot see this eye. I cannot see this eye because this wall is blocking it. Do you understand? This wall is blocking it. So anything below where the price is, I can see the lows below this point. Now, this is this point from here. I can see all the low below this point. Low, low, low. All this low, I can see that. Anyone that is on the other side that you cannot see, forget it. It's not relevant in your analysis. Low, okay. Low, and then low, okay. This is based on where we can see right now. We are saying that this market will do one of two things. You see that this market will come to this low, okay, this low, and break it, test it, and sell. Or this market will come to this high, break it, test it, and buy. Okay, so the market is going to start taking out the previous low that you can see. So in the market, the lows that we are seeing, we call them support. And this support, they are like, it's like walking down a staircase. While resistance is like climbing up a staircase. That's the way both of them appear. Okay. Support is like let me see, I think I shared something like that on the Facebook. Let me see. ZipatFX. Yeah, right here. Let's see. Okay, this was the one I shared. Okay, no, this is not what I want. It's something like this, but this is not what I want. What I wanted to show you is the block structure. Anyway, so yeah, from where you are now, you can see this support, you can see this support, you can see this support. So it's just like you come to this support, you drop to this one, come to this one, you drop to this one, you come here, you drop to this one, you come here, you drop to this one, drop, drop, drop. So it's like coming down the staircase. Why for resistance, it's like climbing up a staircase. So when you are talking of your leg, so a lot of people use different terminology, right, in this forex business. Okay. So when you're talking about your leg of your trade that you are talking about the movement from a low to a high. Okay. So this movement now from here to here is one leg, right? And then the market came back and went another leg, came back, went another leg. Can you see that is like the replica of our C to D that we talk about? That's what they are replicating in that you are calling, leg or whatever. Okay. So
Thank you very much.
the reversal that you are talking about is the U-turn. The reversal is the U-turn. That is where the market forms a candlestick formation. That's your reversal. Okay. So if we talk of this leg, let's say this leg for here now, this market move like this. This market will not sell without reversing. See, in this place, if you mark this place now, we'll say this place is the market did the reversal here. Okay. So that's basically what I can say about that. So, but now I need you to understand the concept, okay? Because if you are doing, like, for instance, your A to B is a movement, your B to C is a movement, and your C to D is a movement. So what is critical for you is, how do you identify that this one is A and this one is B? Okay? Because once you see A and B, the next is for the market to move to C, then you will endure that movement to C. That's why you see that a lot of people, professional traders, you see that they plan their trade for a long time. Sometimes there are some trade that takes a month to set. Some setup takes like 2 years to complete. Okay, once the setup is complete, you now start trading in that direction. Okay, so I want you to see it from that perspective. Okay, because every candle, this is 1 hour, so you have a lot of noise. So I prefer looking at the market on the daily, the weekly, and the monthly. So if you are looking, this is daily, you can see that there are less flicker, there are less noise. Okay, so you just see the market drops from this point all the way to this point. Okay, market drops from here all the way to here. This is one move. Okay, and if you were in that class where I talked about aeroplane and turbulence, okay, even though you see that some small eyes here, those are high that are they are negligible, their effects are negligible. It's not something you want to consider. This eye here, where this market came from and came down, you can consider it a major eye. Okay, and if you consider it a major eye, when the market breaks above it and tests it, like in this case, look at it, the market breaks above it here. The market came here, tested it here, couldn't break. It came back down. It went to gather more momentum. It came and then break it here. Look at it. Break it here and then it came and test here. From here, you're supposed to buy this market to the upside.
Thank you very much. Thank you, sir. Thank you so much, sir.
All right.
Thank you, sir.
All right, thanks. So if we don't have any other question, I think we can close the class and then go do some practice. Please do practice. Practice, check yourself, enter the trade, close the trade according to your plan, okay, and see how well it will work for you in terms of results, okay? See how well it works for you. That will inform that will enable you to make an informed decision whether you want to risk that your hard-earned money, okay, or you still want to hold the hard-earned money in your account. All right. All right, so thank you very much. We'll do this again next week, Sunday.
Thank you very much.
Thank you very much. God bless you. Thank
God
you.
bless you, sir.
Thank you.
God bless you so much.
Thank you very much, sir.
Good night,
Thank you,
all.
sir. Good night.
All right, good night.
Good night.
Merci beaucoup.